If you are currently in the process of applying for a mortgage or thinking about potentially applying for a mortgage and go out and buy that fancy new car, we're going to talk about how that new car might leave you without a house. I'm sitting down with Gary. We're going to talk about the pitfalls to avoid when applying for a mortgage, and we're going to get started right now. All right. Hello, everybody. Welcome to another episode of Pure Perspectives. I'm here with Gary Pierce. Gary, how you doing?
Great. What's going on, Clark?
We are going on. Things are good, you know. Spring in California. Sinus. We were just talking about sinus season. The pollen is out. Cars are yellow. It's a wonderful time to stay on allergy medicine. So, I think one thing that all of us loan officers at Pure Funding experience every day is the surprises that either show up on a credit report or happen during the process of an application that can derail the process of you getting approved for that mortgage and securing that house you're looking at. So we're going to talk about a few things that you absolutely should avoid when applying for a mortgage. The number one thing, Gary, is do not fall behind on your bills. Why is that so important?
Well, number one, any late payment is going to get shown on your credit report, right? So let's say you're at a 700 credit score today. If you miss a payment, who knows what that goes to, right? And it could, depending on the type of loan, late payments and the type of payment, like a mortgage. In some cases, we have products that, do not allow for a late payment within the last 12 months, for instance, right? So, and that goes across a lot of products actually. But it really is a kind of nail in the coffin. Late payments a lot of times. We do get a lot of situations where we're able to work through that, manage it. But you really need to make sure you're making those payments. And even if you're in a house and you're getting ready to buy one, depending on the closing time and date or a refi, a lot of times people will say, hey, should I make this payment this month? And I never advise ever just make the payment. It'll come back to you. I'd rather you make the payment and get a check back in the mail like in 2 weeks versus God forbid something happen. And I say, oh no, you'll be fine. And then you know what's going to happen at that point. Then something happens, they forget, I forget. And then we got a late payment. And so, definitely just make the payment.
Make the payment. And just a reminder that what lenders are looking for is they're looking for your ability to repay. Right? Yeah. Are they confident in your ability to make the payments to repay this loan? That's ultimately what we're looking at. That's why your liabilities, your income, your credit are all factored in. So yes, make the payment. If you have a payment due, make the payment.
100%.
Next, don't open or close any credit cards. Why is that important?
Well, unfortunately, the bureaus have a black box, and who knows why scores go up drastically? Who knows why they go down drastically? But closing out accounts typically are negative. And I'm not a credit expert, so I'm going to make a big disclaimer here. But what we've seen is when people do close accounts, credit card accounts specifically, there is a decline in that. And a lot of times it has to do with your amount of credit that you have available. So let's say you've got 3 cards and you have a limit of 15,000. Let's say you close one of them and let's say you got $2,500 out on that deal. So now you go from a used, credit usage rate of, whatever, 15%, right? And then you close that one, that's $5,000. You go down to $10,000 total usage or total amount of credit. Now you're at 25%. So your usage goes up. So that's primarily the driver. But so definitely don't do that. Definitely keep cards open. You can always do things after closing, but you want to keep your file as stable as possible through the process and going into the process 100%.
So I guess that brings up another good question. So when we go through and we run credit and we work
Mm-hmm.
to get an application and we get all our ducks in a row and then we let the customer know, hey, we're about to pull
Yep.
credit.
Mm-hmm.
What do lenders do? Do they take a fresh look at credit closer to closing, or how does that work?
Yeah, so they'll do on the like towards the clear to close process. They're going to relook at your credit and see where things are. See if you've added any more lines, especially like two of the big things, and we'll probably talk about that here in a minute. Is cars.
Mm-hmm. Yep.
If you open a new furniture line, so that's always I get that call all the time. Hey, we're going to be closing next week, but we need to buy furniture. We want to do the 0%
Yeah.
interest
12
rate
months,
for
same as cash.
12 months, same
Yep.
as cash deal. Yeah, try not to do that. If you do that, it could, it may not impact your DTI in some cases, but it could trigger the lender to kick it back to underwriter to have it reviewed and make sure it's not going to, which would happen anyways. They're going to look at the debt to income because you're adding more debt, right? So if you're on you should always ask your loan officer, hey, if I do this, is this going to impact my debt to income? And typically you can kind of figure it out pretty quick where you stand
Yep.
from a debt to income standpoint. But yeah,
Yeah.
the furniture is a big one. And then the car.
Yeah, and that's the next one. It's like avoid any
Yeah.
large purchases on credit. So furniture being one, but I think vehicles is probably the number one thing that we hear.
Right.
Like, hey, my lease is up. I need to make something happen. I'm going to go purchase. Like, it's bad timing.
Yeah, unfortunately, cars in today's market, I think I saw a stat where it was like somewhere around 20% of all new vehicles last year had a payment over $1,000 a month. So, in the grand scheme of things, if you have, let's just use round numbers, $10,000 in gross income a month that we're using. So we can use 50% of that in most cases on a conventional loan. So you've got buying power up to 5,000, and that includes credit card bills, car payments, personal loans, student loans, and your new mortgage principal, interest, taxes, and insurance, all that included. It's got to stay below 5,000. So if let's say you were at 4,500 when you started the process, and you go buy a new vehicle and you're at $1,000 for that
more
payment,
room. Yep.
you just got declined because now we're $500 over the debt to income, and if you don't have anything to pay off, the only other way to do that is to bring a bunch of cash to closing to lower your loan amount down so that your mortgage payment then is lowered by $500. So yeah, cars are, one thing, if you increase your credit a little bit, that's one thing, but you throw a car on there, you're talking 500 to north of 1,000 most likely on a payment these days. And that's hard to overcome. And especially when you're down to the wire, call it then, final couple weeks of a loan, you definitely don't want to do that.
No curveballs. Yeah, I think, and you raised a good point that I think in the DTI discussions we have with customers, they don't factor in. They don't factor in the new properties, principal and interest, taxes, and insurance, right? That will go against your debt. Now, obviously, it's going to replace if you're selling your house, it will replace that amount. But if you're upgrading, that number is going to be higher, and it's going to be a higher percentage of your debt. So something to factor in.
Yep.
And then more on the liquid side of things, avoiding large deposits or withdrawals. So why does the state of the bank accounts, why does that factor in?
Well, in a lot of cases, so we're required to make and source large deposits, right? And understand where they came from. We're required by law. It's part of the Patriot Act, essentially. And so if you, let's say you make 10 grand a month, all of a sudden you deposit a check for $35,000. And you're needing that for your down payment, for instance. That's going to be a problem. We're going to need to know, not necessarily a problem, but it's going to cause some work. We're going to need to know where that money, Yeah, we're going to need to know where that money came from. Was it a gift? Was it not a gift? Was it part of your income? Can we document that? And then the other side of that coin is if you did get a big chunk of cash that came in and you do have those assets, let's say you've got a pretty nice nest egg. Let's say you got 150 grand in the bank. Well, if you're putting, let's say 100 grand down and you've got 35 grand left in your account or 50 grand left in your account, then we can back that out essentially because you have the cash. We don't have to necessarily source that. But if it's going towards the actual transaction, all those types of larger deposits need to be looked at and sourced and understand where they came from.
Yeah, we'll basically be asked to provide an explanation, like why is this gift funds? Is it what is this? Where did it come from? Because they want to know.
You see that more. You see that more on like self-employed borrowers because hey, I just finished a job and we got paid a big chunk of money. Things like that. I mean, it's common. It's not one of those like. It's in our world. It's so common that we do it all the time. It's not. Yeah. It isn't going to derail the deal most likely, but it's something to be aware of anyways.
And then the last one is don't change jobs, like keep consistent employment. Why is that such a big deal?
Well, you talked about it earlier. It's your ability to repay. If you started the process and then you decided 2 weeks in that you're going to take a few months off of work and move into your new house and get all that done, that's fine, but a lender is not going to appreciate that. And their way of showing that is going to be a decline of your file because you don't have income anymore, right?
Yeah.
So it's pretty simple. There are a lot of ways that we do prove new jobs, right? So you can get a loan as long as you're starting, depending on every product, conventional, FHA, VA, they all have different guidelines. We won't get into the weeds on that too much, but we do have ways where we can get your job, your offer letter. You can get a new offer letter, bring that in. We'll do a verify your employment with your employer, that sort of thing. Hey, did Clark actually get this job, and is he starting on April 27th? Is that indeed happening? Yes, that is. And then he'll verify, okay, yeah, he agreed to this, income. This is what he's going to make. This is, that sort of thing. And as long as that all is similar, if not better than what we had before, shouldn't be any problems. But it's just one less thing you just don't want to add wrenches into the program at that point. Like get through the 30 days, keep everything as stable as possible and close to what you started the deal with. And then after closing, do what you want to do. I mean, within
be safe,
reason.
But do it.
Yeah, exactly. So
anyways,
no Ferraris. Yeah.
Yeah.
So,
no. I think, those are the main ones. I think they're probably the most common when we're talking to customers and we're going through the process. Running credit and seeing all the liabilities and maybe late payments. These are the most common pitfalls that you're going to run into when applying for a mortgage. So, just a reminder, give us a subscribe, give us a thumbs up, hit that bell. You'll be alerted when we have new content coming out. Hopefully this is helpful. I hope it'll make everybody's lives easier when they're applying for a loan, but these are the pitfalls you definitely want to avoid when applying for a mortgage. So thanks so much for joining, Gary. Thanks, everybody, and we look forward to chatting with you soon. Take care.